All right, let's get right into it. The official data coming out of the Comex Silver Market, well, it's sending a very clear signal. A major stress event might be just weeks away. In this explainer, we're going to break down the numbers and show you precisely why. So let's start with a really simple statement. The math for the upcoming March silver delivery month, it just doesn't add up. And, when the numbers stop making sense in a market that's built on the promise of physical delivery, something has to give.
And we're not talking about some small, obscure corner of the financial world here. We are talking about the Comex, the world's #1 market for figuring out the price of silver. And the data, it suggests it's under some serious and accelerating stress.
Now, I want to be crystal clear. What we're about to walk through isn't based on rumors, it's not speculation. This is an investigation based purely on the official Comex data. We're talking delivery trends, inventory levels, open interest. It's just arithmetic. And believe me, the clock is ticking. We are just about 3 weeks away from February 27th. And why does that date matter? Well, that's first notice day for the March contract. It's the moment when all those paper promises have to get backed up by real physical metal. So to really get a grip on what's happening now, we've got to look back at last year, because 2025, well, it marked a fundamental, game-changing shift in how this market operates. Just look at this chart. In 2024, the Comex delivered about 203 million ounces of silver. Fast forward to 2025, and that number just explodes to 474 million ounces. And this wasn't a fluke. It wasn't 1 or 2 big months. Every single month in 2025 saw higher physical deliveries than the same month in 2024. That's a 2.3 times increase year over year. So the crucial point here is this tells us there's been a systemic shift. People in this market are no longer just using Comex to hedge with paper contracts. No, they're increasingly using it as a way to get their hands on the physical stuff. They actually want the metal. And that brings us to this year, where the first 2 months have thrown up some really serious warning signs. Signals that this trend is not just continuing, it's accelerating dramatically. Now, what's so interesting here is that January is normally a pretty minor, quiet month for deliveries. But look at this progression. It goes from 6.8 million ounces in 2024 to a jaw-dropping 49.4 million this year. You know what this looks like? It looks like front-running. It seems like people weren't willing to wait for the big delivery month of March. They wanted their silver early, probably because they were worried it wouldn't be there later. Then we get to February. And honestly, this is the smoking gun. A nearly unheard of 98% of the open interest stood for physical delivery. I mean, in a normal, healthy futures market, you might see 5, maybe 10% stand for delivery. In a stressed market, maybe 20%. But 98%? That is something else entirely. The takeaway here is absolutely crucial. When delivery rates hit these kinds of levels, the market isn't really functioning as a tool for hedging risk anymore. It's become a strained, creaking system for allocating a very scarce physical supply. Okay, let's move on to the main event, and you'll see how this all builds. We're talking about the March contract, where massive potential demand is on a direct collision course with a rapidly shrinking supply. So as of early February, the open interest for the March silver contract, which is just the total number of outstanding contracts, represented a whopping 429 million ounces of silver. Now, of course, not all of that is going to demand physical delivery, but based on the recent trends we've seen, a very significant chunk of it will. So let's run a few what-if scenarios. If a conservative 25% of contracts stand for delivery, that's still a demand for 107 million ounces. In a more moderate stress scenario, let's say 50%, that's 214 million ounces. And if we see a high-stress situation, like the one we've been trending towards, a 70% delivery rate would demand an incredible 300 million ounces of physical silver. Now for the other side of the equation, the supply. This is the inventory of what's called registered silver, and it's the only metal that can legally be used to satisfy these futures contracts. And, well, it's been collapsing. It's fallen from 167 million ounces back in October down to just 103 million by early February. That is an alarming 38% drop in just over 3 months. The inventory is literally draining at a rate of over 780,000 ounces every single day. If that pace keeps up, the available supply could be down to just 85 million ounces by the time March delivery even begins. And here it is, the collision course laid out plain as day. Even our most conservative demand scenario of 107 million ounces is threatening to completely overwhelm the projected available supply of about 85 million. The moderate and high stress scenarios, they aren't even close. The numbers, they just do not work. So the big question is, what happens when this irresistible force of physical demand meets the rapidly shrinking object of available supply? What are the possible outcomes here? Now, a common argument you'll hear is, but what about all the eligible silver that's also in the Comex vaults? And this is a critical distinction you have to understand. Eligible silver is privately owned. It might belong to an ETF, a big bank, or a wealthy family. It is not available for delivery unless its owners voluntarily decide to convert it to registered status. And that brings up a really simple question of logic, right? If you owned a huge amount of physical silver and you saw a delivery crisis brewing that was probably going to send prices soaring, why on earth would you sell it now at current prices? You wouldn't. You'd hold on for dear life. Look, even if the Comex somehow, miraculously, manages to scrape through March, maybe by delivering every last registered ounce they have, the problem doesn't just vanish. The inventory would be functionally at zero, and the May contract, which already has over 130 million ounces of open interest, would be staring them right in the face. The issue just gets kicked down the road. This really only leaves a few ways this could play out. First, you could see massive numbers of contracts get rolled over, which is just kicking the can to May. Second, the Comex could be forced into cash settlement, which basically breaks the fundamental promise of physical delivery. Or third, in a worst-case scenario, you could see an outright default. None of these outcomes are good for the credibility of the paper silver market. So the integrity of the world's primary price discovery mechanism for silver is really hanging in the balance. And that leaves us with one final, provocative question that gets to the very heart of the situation. When paper promises finally slam into physical reality, what's going to break first?